2 out of 3 Canadians pay out their mortgage before the end of a 5-year term.
I'm ready to buy my first house.
Boom. It gives you a pre-approval.
Wow.
Yeah, so that's the minimum, 9 million.
99999. It's a lot of numbers.
80% of people probably do.
Woohoo! It's really exciting.
It's hot topic.
Yeah, I know.
Or you want to refinance, or rates are lower, or.
I wish I had a boat loan.
Yeah, me too. But maybe the next term.
Right.
Or the next one.
Wow, that's big.
It's a deep stuff.
I love it. It's a deep dive into mortgages.
You can do anything you want.
Oh, that's good.
Yeah.
I don't know. Well, that sounds simple.
It's simple.
Let's talk about mistakes that people make.
I can make mistakes. I'm human.
What do you want to not do?
What the hell was I thinking? I don't know.
Yeah.
But sometimes it happens.
Yeah.
The Red Chair Podcast. Real truth behind real people in real estate.
Well, hello again, and thank you for joining us here at the Red Chair Podcast. My name is April, and I'm your host here on the Black Couch, and my guest today is in the Red Chair, and we are so happy that you have joined us today. We've got a great conversation for you today on the financing process, which is sort of the key main thing that you need to know about when you're considering buying a house or selling and rebuying or whatever. So I'm very excited to have our guest with us today, Jason Chapman from Pacific Shore Mortgages. Jason is one of our key partners at LePage Coast Capital. We always love to hear from Jason about rates and products and all the great things that content that he brings. And we were just joking beforehand. This is a bit of a long intro here, but we were just joking that mortgages is not really a sexy conversation. It's not very exciting, but we're going to do our best, right?
Do our best. It's not usually the life of the party.
Yeah, but that's okay. We're going to have fun with it. So Jason, thank you for joining us. Tell me a little bit about your background. Why are you a mortgage broker? What did you do before? What's your history?
I have been in the mortgage industry basically since... I think I wrote my first mortgage in 1999. So I started banking in 1997, but did my first mortgage in 1999. I have been kind of like all over the industry, from underwriting to administration to collections and foreclosures, as well as leading a team, a whole bunch of things like that. My last job before I became a broker was I was working at CIBC, working at a bank, and I didn't like that I had to fight against my client a little bit. So I decided to become a mortgage broker because I wanted the freedom, and I wanted to fight for my client, and I really enjoy it, and that's sort of my background.
That's great.
Yeah.
So, I mean, I think the big ticket question right off the top is, what is the difference between a mortgage broker and getting a mortgage at a bank?
The biggest difference is sort of the options available. So you can imagine if you go into your bank or credit union and you apply for a mortgage, you just get what they can offer you. So they'll qualify you based on their products, based on their policies. They'll qualify you based just whatever is in-house, but everybody's different. And for the average person, I might have 30 options for them. They might fit a client better. So opportunity for an actual approval at the end of the day, I would say, is greater in many cases. And obviously the working with a broker as opposed to a bank, we just have way more ways that we can fit a client to get an approval to get into the home that they want.
Right. So what you're saying basically is banks sort of have like a set parameter of what they look at and how they qualify, and the mortgage broker has just a bigger pool to choose from.
Yeah, exactly.
Yeah.
Banks just have their own policy, and maybe you're going to fit with it.
Yeah.
In fact, 80% of people probably do. Maybe not that high. But there's a whole bunch of people that have weird ways of qualifying, or have income that's unique, or self-employed, or just something that's different, or the property, or all kinds of things that can go into being approved for a mortgage.
And would you say that the banks sort of have really set interest rates that they kind of this is it, we can't do better for you, whereas mortgage brokers might have a little bit more sway there?
It depends.
Okay.
Right now, banks are being very competitive. They are doing They're doing a great job on rates sometimes, especially for their own clients on renewal. So sometimes I can't beat a bank. I would say most of the time throughout my career, I typically can beat a bank. With this lender or that lender or this special, you got to fit into a little box, whatever. But I would say that when it comes to rate, most of the time, yeah, I can usually beat a bank. I've got all kinds of tools in order to beat the bank, but this particular month is a little tough.
Interesting. Okay. Yeah. So banks are kind of stepping up a little bit because they are maybe feeling that pressure. They want to make sure they're getting that business too. So it
Yes.
is competitive.
Well, right now, I think there's something like, I don't know how many billions in mortgages are coming up for renewal in the next 2 years, but I think it's like 2/3 of all mortgages are coming up for renewal. So, banks have built their retention teams because this is such a big, large amount of mortgages renewing.
Right.
They're building retention teams, and they're taking a little bit sacrifice on their rates in order to keep their clients.
Right.
Even the lenders I use are keeping their clients. I help my clients at the end of renewal time to see if there's a better rate out there, because we can just transfer mortgages for free basically anywhere you want. So if there's a better rate over here, a better opportunity, we can just move them. Or if their lender is amazing and they're happy and they get a good rate, that's great. They should just stay there.
Right.
So, but the retention teams have been built out.
Yeah.
For this moment.
Yes.
Yes.
Yeah. Well, so we're going to talk about refinancing because that's a really key thing. But right from the start, let's just talk about the mortgage process. So, I'm a new person. I'm ready to buy my first house. And I don't know the first thing. Like I've gone out and I've started looking. I found the house. totally in love with it. Haven't even talked to my bank yet. That's not a good plan.
Not a good plan.
And hopefully, the message would be find an agent, start talking to your agent, and help. They're going to help guide you with these steps. But really, the key thing here is I need to know if I can afford this. So what is the process for a new buyer that is ready to, like, what can I even afford?
Well, the first step is to get a pre-approval or a pre-qualification, and I would suggest that it's important that people talk to somebody. Make sure they're providing documentation, because when I say pre-approval or pre-qualification, these are different terms meaning different things, and each come on a spectrum. Let me give you an example. Say you go online and you go, I need to get pre-approved. So you go online and you see this link that says pre-approval in 60 seconds, and you think that's fantastic.
Yeah.
So you go and do that. Okay, so at the end of 60 seconds, you fill out a bit of information, and then it asks for consent to pull credit. Boom, it gives you a pre-approval, and you think you're done.
Yeah.
Okay, but no one's looked at your like a single document. They have entirely pre-approved you based on what you told them.
Right.
And that's not always good, because I receive a lot of applications from clients, and I'm always making changes because people, it says, what's your income? And then they just for example, they might just look at what their T4 was for last year. Well, okay, what if you got a bonus income included in that? Or what if it was overtime? That's things that aren't typical that you might not always get. And not all lenders will take that. So you could go out and think you're great and awesome. And then when you go get for your real pre-approval, okay, now the lender's calling your employer, asking how much you make, verifying your income. And all of a sudden there's a problem because you said you made all this money from your last year's T4, but we can't count some of that. So now you kind of, you might lose the ability to put an offer in.
Yeah.
So when I say it's on a spectrum, so a better quality means to go have somebody asking you, can I see your documentation, give me a pay slip, that sort of thing. Now you've got somebody asking the right questions.
Yeah.
And so you get a much more high quality pre-approval or pre-qualification.
Right. So when you're filling out that online form, or even if you're having the conversation with the person, are the questions being asked about your income, but also your expenses?
Not quite.
Okay.
Here's the answer is, because when I do a pre-approval or pre-qualification, I pull their credit. So I get all of their expenses that are included in the mortgage, at least the qualifying part. So I'm not looking at their expenses like if they have a golf membership or whatever. That's not part of the qualification process. Like as far as the lender goes,
Okay.
might be something that they would want to consider
Right.
in their budgetary for budgetary reasons. So basically, I pull the credit, I get all the debt, and I can service all the debt. I know exactly what to do and how the formulas to calculate that. So I have that part. And then, of course, I'm also calculating the qualification of the actual mortgage. So I'm looking at the mortgage payment, the property taxes, strata fees, all that stuff.
So that debt is going to show like any car payments they're making, you know, if they have they bought a trailer and they're financing it, or it's going to show all of those things in the debt.
Yep, exactly. Yeah.
So you get all that data, which that's the right way to do it, to give it to the mortgage broker to have them run it thoroughly. Don't rely on what you get back from the automated system. That, you know, it's just not enough.
Absolutely not.
Yeah.
Like an application is so nuanced that even like, okay, I've been doing this a long time, and even I can make mistakes. I'm human.
Yeah.
Like I had a client, just to give how many different ways that when you don't talk to anybody, even when you do talk to somebody, you can miss. Like I recently did an application with somebody. I looked at their payslip. They told me that they're full time, and I asked them to send me a payslip. I got a payslip. Yes, 40 hours per week, full time. This looks great. Awesome. So everything seemed fine. The client told me they're full time.
Yeah.
But there was a nuance to this, because this client was only full time during the summer months.
Oh.
She was seasonally full time.
Yeah.
So come autumn, she was going to go to more of a part-time position with that employer.
Yeah.
Of course, that never came up, and I wouldn't even think of asking that, because everything seemed to line up to be, full time.
Yeah.
But it's just an example of that's one of like 75 things that could, that can
get missed. Yeah.
So if you can imagine somebody going online, filling out their application,
right?
Like, there's 75 things that there's no way they could think of, because I don't always think of all the things. Like,
Yeah. Yeah.
So.
Yeah. Wow. That's big. Yeah. Wow. That's kind of scary. Okay. So pre-approval, you've answered all the questions, and then you're going to say, you've got your pre-approval. Do you give them like an actual number? Like you can't go above this price.
Yes.
Okay.
So I usually give them the amount of the mortgage that they're qualified for. So, let's use an example. A pretty common mortgage number in Victoria might be $700,000. So I might say you're qualified for a mortgage of $700,000. Add your down payment to that.
Right.
So that's your maximum purchase price. So I focus on. I make sure that they have also. Do you have savings? Like, do you have a down payment?
Yeah.
Because if you don't, we have another problem, of course.
Right.
But if they understand how much they can borrow, right, because that's their maximum, then they can sort of set their budget.
Yeah. So what we're talking about there is the down payment. What's the minimum amount that you need to have in a down payment?
So it depends on what you're buying.
Okay.
So 5% on the first $500,000, then 10% on the remainder, up to $1.5 million. If you buy $1.5 million and 1 cent, you got to put 20% down.
Wow.
Yeah, so that's the minimum. So if you want to put a lower down payment, you have to cap your purchase at 1 point.
Okay, and so you have to be really strategic on how you offer then too, and make sure that you're under, so that you don't trigger a higher down payment.
Yeah, your offer could be 1.49 million.
99999,
and then that's it.
Yeah. Wow.
Yeah, so I'd tell the client how much they're pre-qualified for, and that's how much down payment that they need, and then we make sure that they have it, and that they also understand that part of that down payment also has to include closing costs. So they might need to pay property transfer tax. Like, nobody thinks about that.
Yes.
Property transfer tax, that's part. They need that from their own money. It can't be financed. So they gotta. So if their down payment, if they only have $100,000, and they think that's their down payment, and that's all the money in the world that they have, but they might have to pay property transfer tax if they don't qualify for the homeowners grant or first-time homeowners grant. Then their down payment is actually, maybe $88,000, for example.
Yeah. Yeah, so they're going to need to have that additional funding there for the property transfer tax. Also, too, I'm just thinking, if it's a new construction and it's subject to GST, your purchase price plus GST. GST is not financeable as well, correct?
No, it can be.
Oh,
Depends on how the contract's written, but mostly
okay.
it's finance. So the purchase price, let's use easy math here because I like easy math. You like
Yes,
easy math?
yeah.
Okay, so they purchase for $1 million on a new construction,
Yeah.
and then they have to pay the net GST on top of that. So maybe with the net GST, it comes to, I don't know, we'll say 1,029,000
Right.
or whatever the number is. We use that 1,029,000 as the purchase price. Lenders will accept that as the purchase price, even though the real purchase price was $1 million
Right.
in this case. As long as the contract says purchase price includes net GST.
Includes, yeah.
Sometimes the contract will say purchase price excludes GST,
Right.
and in that case, I don't really see that much anymore. I'm pretty sure in that case that now it can't be financed. You're gonna have to
Right.
pay the GST separately.
Right. So that's a good point. So hopefully your trusted agent, your trusted real estate advisor is writing the contract correctly in order to, assure that you can kind of finance that GST portion of the purchase price. So,
Yeah, if you need it.
Yeah.
There are situations where I suppose I'm not an accountant, but I guess depending on the situation of the person where it may be more beneficial for them to pay the GST and get the rebate themselves. I don't know,
Yeah.
but sometimes it happens.
Yeah. So, okay, so the average person is approved for 700,000. That's probably a condo or a townhome. Those strata type properties are usually subject to strata fees.
Yes.
So how does that work into the financing and pre-approval equation?
So when we're qualifying, when it comes to the strata fees, we only need to count 50%.
Okay.
I don't know why, actually, because you have to pay all of it.
So let's say it's $500. You're only accounting for 250.
Right.
Okay.
Yeah. So I only do half of it. So we include it in the calculations for qualifying, and that's it. So it's pretty straightforward for
So
the strata fees.
as long as that's doable in terms of their, amount of mortgage per month that they can pay, it's okay. So do you find that there are cases where they're looking at a strata, they've put an offer in, you're doing the financing, and it's like you actually can't get approved because the strata fees are too high?
Yes.
Okay.
That's actually a really good point because you got to think like when I'm doing a pre-approval, I'm making assumptions in there. Like
Yeah.
I don't know what the property taxes are really going to be
Right.
or what the strata fees are going to be. So, I'm taking, I talk with the client and I'm like, what do you think we should use for strata fees? Like $450, $550. And that's reasonable, right?
Yeah.
And if they go all the way to the top of their financing and they get the most expensive property that they could possibly be qualified for, but then the strata fees instead of being $550 or $700
Right.
or something, and it's like, well, we
You
didn't.
just blew the bank.
Yeah, we didn't anticipate that.
Yes.
We couldn't
Yeah.
do it.
Yeah.
So I mean that happens pretty rarely, but it certainly can happen.
Yeah.
Like when I qualify borrowers, I know I said 700,000, but I usually leave a little bit of room.
Right.
So I know that I can not manipulate, I should say, I know I can massage this deal a bit
Yeah.
to get them to qualify for 710. So
Right.
it's always a little extra in there because just in case they go all the way, I don't want them to be disappointed.
Yes.
But I always tell them that. I'm like, here, it's 700. I might be able to squeeze out a bit more, but
Yeah.
talk to me before
Yeah.
you put an offer around there.
So once that is all established, do you connect then with the client's agent and say this is their top? Like, do you have that conversation with the agent?
Yeah, I usually do.
Yeah.
Usually just let them know that they're good to go so the agent can feel confident.
Yeah.
Because sometimes the client gets a letter from the lender, but most lenders don't offer a pre-approval letter.
Right.
So the client has nothing to show the realtor.
Yes.
So I usually just give them a call or send them an email and just say, client's good for this amount.
Yeah.
If the client gets anywhere near this, please contact me
Yeah.
and we'll make sure, send me the MLS and I'll run all the numbers perfectly.
Right. Okay. So pre-approval, found the property. I'm thinking about all the potential pitfalls here.
There's so many.
There are so many. There really are. So you've put the offer in. You've done the financing. There's also an appraisal component to this, right? The lender is generally going to appraise the property. And is there a possibility that they do that and then they say, we're not going to borrow money on this? It doesn't feel like a good idea for us to do.
Yeah. So appraisals are interesting. So we're seeing lenders ask for appraisals a little bit less. They do run them through computer valuation models often, and if it's insured, like CMHC, et cetera, anyone putting less than 20% down, those typically don't require appraisals.
Okay.
As long as it's an MLS listed property and the price is about where it should be.
Right.
Okay. So then we don't need an appraisal. But if we do, yeah, sometimes appraisal could come in lower than expected. That doesn't kill the deal.
Okay.
Okay. All that means is the lender is going to say, okay, you put an offer for $1 million, but the appraisal says it's only worth $990,000. So now the lender is going to say, look, we're basing our lending value at $990,000. So you might have to put in your own extra $10,000 on that one.
Okay.
Still can go forward, but
So that 10,000, if they don't have it, can they borrow it from someone?
no.
That's tough.
Gotta have it. Yeah.
Yeah.
Well, no. Wait. Sorry. Your question was, can they borrow it from somebody?
Well, yeah,
Sure.
like,
Why
you
not?
know, if your parents have 10 grand and,
The only thing, if they're going to borrow it, we have to debt service it.
okay.
Okay, so it's got to be reasonable loan, but it's much better if mom and dad just gift them the 10,000.
Right.
You know?
Okay, so it can be a gift.
Definitely could be a
Cool.
gift. Like that's no problem.
Great. That's good. Yeah, like I think sometimes those things do happen. It is a reality. So I do like what you're saying in terms of like, for those high ratio mortgages, generally an appraisal isn't being done, is what you're saying.
No, I would say, if I had to guess,
Yeah.
I'd say about half the time appraisals are required.
And first-time buyers, forgive me if I'm wrong, first-time buyers are generally high-ratio mortgage
Yes.
people.
Yeah.
Yes.
For sure. Yeah, they're
And that means you're, 5% or 7 or 10% down payment.
exactly.
Yeah.
Yeah, first time buyers. I mean, like what if you put less
Who
than
has
20%?
20%?
Exactly. If you put less than 20% down, you have to go. Yeah, you're an insured mortgage.
Yeah.
And how many people are buying? Even if they're buying a small condo for $500,000, how many people just have $100,000 sitting in their bank accounts with 20% down?
No one.
Nobody.
Yeah, so 20% is that conventional mortgage. Usually those are people that are selling something. They've got some equity that they can take and port to the next one and use it for, a larger down payment on the next one.
Yeah. It's just
Yeah.
like getting on the ladder, that first rung, and each gets a little bit easier because
Yeah.
you build equity. So you buy your next home, you've got a bunch of extra money to put down on that home.
Yeah.
So you could actually grow into bigger properties and still, keep your mortgage the same, or maybe
Right.
it won't grow as fast
Right.
as the purchase prices.
Right. And so these high ratio mortgages as well, they are subject to, they're insured mortgages. So you're paying principal, interest, tax, and also a bit of insurance, correct? Like your monthly payments have a bit of mortgage insurance in them.
Correct. So the insurance is paid all at once at the very beginning.
Okay.
It can be financed. 99% of the time it is financed.
Mm-hmm.
So that just means you get your mortgage for $700,000, and then the insurance, whatever the insurance premium is, let's say $30,000,
Okay.
just gets added to the mortgage. So now your mortgage is $730,000, and I would have already assumed that, by the way, in my original calculation.
Right. Yeah.
Just in case that wasn't clear. So then, so it's added to the mortgage. But one of the advantages of insured, when everybody's going online, they're looking at rates, right?
Yeah.
They are going, I saw this rate. It's really great. Why can't Jason Chapman get that for me? Well, those rates you see are insured mortgage rates. So if you're insured, if you have an insured mortgage, you get the best rates, get the lowest rates because it is a zero risk mortgage for a lender. That insurance, that $30,000 that I gave you in my example, is what you paid to protect the lender against any loss on this mortgage. So because you did that and the lender has a zero risk mortgage,
They're happy.
they're happy.
Yeah.
It's cheap. They don't have to put like money aside for loan loss provisions for you because there is none. All the risk is on the insurer and
Right.
none on the lender.
And that 30,000 over 25 years, it's really a very small amount in your monthly payments.
Totally.
Yeah.
Oh, yeah.
Yeah.
Yeah. It's not
So it
very,
sounds like a lot, but it really isn't.
exactly.
Yeah.
Yeah. And you get the benefit of a lower rate. So
Yes.
sometimes it offsets a lot of the cost of the
Right.
insurance because you're getting a lower rate than if you put 20% down.
Exactly.
Yeah.
Yeah. Okay, let's talk about debt service.
Okay.
Woohoo! It's really exciting.
It's hot topic.
Yeah, I know. This is where we lose half the
Yeah.
audience. Stick
Stay
with us.
tuned.
I promise the end will be great. But it's important to know about debt service. Your ratios. So we've got GDS and TDS. These are the things that we learned, in real estate school way back in the day that we could talk to our clients about as well. But let's explain what GDS and TDS are.
Okay. So GDS stands for gross debt service. So it's a gross debt service ratio. It is the percentage of your monthly household expenses relative to your gross income. So what I mean by that is it takes your mortgage payment, it takes your property taxes, it takes heat, so electricity, and 50% of your strata fees if applicable.
Okay.
So when you add all those things up, it cannot exceed 39% of your income. In most cases,
Right.
There are, like I said, there's so many lenders out there. We can do all kinds of things, but this is just going to speak generally because that's going to cover 80% of mortgages out there.
Right. And that's your combined income, right? Like if it's two of you, it's that 39% combined.
Yeah.
Okay.
So gross household income, which means before any taxes are deducted from your income. Then we have another calculation, and it's called the total debt service regulation. The difference is gross debt service just includes the property.
Yeah.
Total debt service gives you a little bit more room because you might have a credit card or a car loan, or you might have a line of credit. Like, who knows?
Right.
But people live lives that have credit.
Yeah.
So in this case, the total debt service ratio is typically will allow a borrower to go up to 44%.
Okay.
So the borrower has to pass both of these tests.
Right.
The gross debt service ratio and the total debt service ratio. So that covers most of the lenders. If you can meet under those criteria, you're good to go.
You're good to go.
Yeah.
Cool. Well, that sounds simple.
It's simple. And then if you don't, no problem, because I got 30 more lenders that will go exceed these or look at things differently, or maybe look at some income that you have that other lenders won't consider.
Good. So that's a great thing. So I think, for a buyer that's, getting into the market, I think it's important just to sort of sit down maybe together, or if it's just you, and write down all of these things. What are our incomes? What debts do we have? Like the big ones, like a car, a boat, a trailer, whatever it is. What do we spend every month? And remember things like the gym, daycare, your subscriptions to different apps, your Starbucks addiction, all of these things.
Gambling addiction.
I hope not.
Well, I've seen it.
Yeah. And can they still get a mortgage with a gambling addiction?
Well, just don't tell anybody.
Okay. But no, I think it's important to sort of really take a snapshot of where you're at. And maybe the time isn't right. Maybe you're not going to get those GDS and TDS percentages that you need, but maybe it's a real wake-up call to kind of look at some of the things you're doing, adjust, and then maybe save a bit more and go when the time is right.
Yeah, and it depends on what those things are, because some of those things you just mentioned are already included in the lender's ratios. They're looking at that.
Right.
So that's your boat loan, your car loan, and any debts you have.
I wish I had a boat loan.
Yeah, me too. I wouldn't mind one. And then also but other things like the discretionary stuff, like a lender would have a clue that your golf membership or your kids going to a private hockey school because it's going to make the NHL one day, So and those are expensive things, but they're not this discretionary. So you choose to do those. So you got to make sure that those things fit within your budget.
Yeah.
But a budget is personal.
Yeah.
The lenders,
That's true.
not going to control your personal budget.
Yeah. So let's talk about the refinancing piece, because this is true. I think there were a lot of mortgages that started during the pandemic. We saw, in terms of real estate, we saw huge numbers of sales during the pandemic. And we're heading towards a lot of those renewals coming up now, or even in the next couple of years. And so for those that are out there that are going, oh my goodness, my mortgage comes up in 2 years and I'm going to lose my house because the rates have gone up and the uncertainty, that buzzword of the market, can we just calm down about that a little bit and talk about What is refinancing? Let's start there.
Okay. So you asked about refinancing or renewal? The renewal.
Well, that's good.
Yeah.
I don't know.
Okay. Well, let's
Explain
talk.
both to me.
Well, your part of what we're talking about was definitely renewals. Like,
Yep.
so all these people during the pandemic had mortgages at 1.9%,
Yeah.
1.6%, and now they're coming in and their mortgage rate starts with a 4.
Yeah.
And so some people might think, well, if I was at 1.9 and now I'm at 4 or higher, my payment's going to double. But that's actually not the way the math works. So the good thing is, well, I'm sorry, the bad thing is your payment probably is going to go higher.
Yeah.
But probably not as much as you want.
Right.
So when what you do have options at renewal. This is a time to reopen your mortgage.
Okay.
So what some people, if they really are stressed about, the payment is going to go up $400 a month. Okay. Well, what we can do is extend the amortization, for example.
Okay. Explain that.
So let's say 5 years ago they bought their house and they have a 25-year amortization.
Okay.
Amortization being the period you pay off the mortgage.
Yeah.
And you come up for renewal, and now you've got 20 years left. So now your mortgage is being amortized over 20 years, but the
Right.
mortgage is smaller because you've paid some down.
Right.
So at this point, you can just carry on, get the new rate, and carry on 20 years. Keep your amortization going, or maybe you want to bump it up to 25 years, or even 30 if it's really you've got some other priorities in your life.
Mm-hmm.
So that's the renewal part. Those are the options you have at renewal. But also, remember, your mortgage is open at the end of the term. You can do anything. You can also refinance.
Mm-hmm.
So refinance is when you get money from your mortgage, like you increase your mortgage and put money in your pocket. Not in your pocket, but I mean you get some money from your mortgage refinance, and you can use that to pay for things, like pay off debt, or pay for your children's college funds
Yes.
coming up, or invest,
Yeah.
or whatever you need to do.
Yeah.
That's every time your renewal comes up is a free opportunity to
Add
look
more.
add more or look at your financial situation.
Right.
Like, what's your priorities are?
Yeah.
They're probably different than they were 5 years ago. 5 years is a
Right.
long time.
Yeah.
And things that you didn't think about then, like my kid was 12 and now my kid's 17
Yeah.
and they're going to college next year. They're
Yeah.
in
And I
university.
didn't have any RESPs or whatever.
They were 12. I
Yeah.
wasn't thinking that far ahead.
Right. Right.
So
That's a good point. I remember doing that many years ago. One of my very first mortgages, when it came up for renewal, we had some debt that we had acquired from being a young married couple, and we wanted to do some renovations and things.
Perfect
So
example.
at our renewal, I think we added probably $20,000 or something, and it was great because we could just take that money, pay off the debt, and so then we weren't paying those big interest rates with the credit cards. It was now rolled into the mortgage to be paid out over time, and it was brilliant.
makes perfect sense.
Yeah, yeah. So that is a real benefit for sure.
Yeah.
Repayment. Are there rules in place about how quickly you can pay down your mortgage? If you get an inheritance and you want to put $100,000 on it that year, can you do that?
You can do anything you want,
Okay.
but it may come with a penalty.
Okay.
So lenders have rules where they protect themselves from you just going, every time rates drop, for example, just paying out your mortgage just to get a new lower rate, because that's terrible. That'd be terrible business, and they would never be able to fund their operations, obviously. So there are penalties, limits, where lenders will allow usually between 10 and 20%, depending on your lender, 10% to 20% of the original mortgage amount, where you're able to prepay, so you can pay down that amount without any penalty at all. No problem. Go right ahead. Do this every 12 months. Every 12 months, you get another 10 to 20%.
Right.
So that's one way you can pay down your mortgage. The other way is lenders will allow you to also, in addition to that, increase your mortgage payment. So some will allow you to increase the payment. So by 15%, or some will allow you to double it. So 15 to 100% increase in your payment. You can do both of those things, those lump sums that we just talked about, or or increase your monthly payment. So those are ways you can pay down your mortgage quicker. Only to those limits, though. If you go above the limits that I just said, then you start getting into penalties.
Right.
Penalties are probably the most misunderstood and not talked about cost of a mortgage. When you think, if I were to ask you, April, what's the most important cost of a mortgage? What would you say?
Principal.
Oh, sorry. I mean, like,
Oh.
what causes? Yeah, you're right. The principal is ultimately.
I want to pay the principal down as fast as
Yeah,
possible.
well, most people would say the rate.
Okay.
They would be like, that's the cost.
Yeah.
I want a low rate because that's going to cost me less. And that's totally understandable. And that may make sense. But if we change the question from, okay, what is rate more important than cost? So you might get a good rate, but that doesn't mean you're going to pay the least amount because this penalty. Okay, so in Canada, 2 out of 3 Canadians pay out their mortgage before the end of a 5-year term. So that means 2 out of every 3 people pay a penalty. Just think about that.
Wow.
All of those people think they're just going to go for a 5-year term and they're not going to pay out their mortgage. Why would they?
Yeah.
I mean, I'll tell you why, because life happens. People lose their job. There's a health problem, marital you get divorced,
Yeah.
or you have more kids and you need more bedrooms.
Right.
So you've got all these, or you want to refinance, or rates are lower, or lots of things happen that cause people to have to pay out their mortgage. They have to move, they get transferred from work, whatever. So then these penalties become important. Now, if you do the math, if you're a banker, they've done the math, they know how this works. 2 out of 3 people are going to pay a penalty. So and those penalties aren't like $1,000.
Right.
They can be up to $30,000, $40,000, $50,000.
Wow.
Okay, so you want to think about that. That penalty is important. So it's the terms of the mortgage that are important. If you know that statistically there's a 66% chance you're going to pay a penalty, do you care about that 0.01% you saved on the rate? I hope not, because the cost overall, you might not pay a penalty this time, but maybe the next term,
Right.
or the next one.
Right.
So if you're always going just for the rate, and not at least considering,
Right.
there are lenders out there that have a lower penalty. Maybe the rate's not as good, or maybe it's the same. But let's say it's not as good, because that's what people always tend to focus on.
Yeah.
But that other lender who had a slightly higher rate may save you the cost over time.
Right.
Because you won't have to. Their penalty, as an example, we have lenders called monolines. Sorry if I'm blabbing here, but
That's good.
like
That's
I'm just
good.
going on. We have lenders called monolines, meaning one line of business, just mortgages.
Right.
And their penalty, we call them fair penalty lenders, and their penalty is, a rule of thumb is about 1/3 what you would get at a chartered bank.
Right.
So a bank would be triple. So that 30,000 penalty example that I used, if you're with a monoline, would only be, your rule of thumb, 10,000.
Right.
So that's significant.
Yeah.
It's like buying insurance for yourself. That little tiny a bit of percentage higher is like your insurance against that problem happening.
Wow.
So yeah.
You see me glazing over a little. It's like,
Yeah.
this is a lot. Like, it's really, there's so many moving pieces to it. So
It's the most
yeah.
under discussed topic.
Yes.
Because it is so important, because it's big numbers. It's not like a couple $100.
Yeah, it's a lot of
It's
money.
like
Yeah.
tens of thousands.
Yeah. Wow. I mean, we're bringing the truth here today.
Yeah, this is
good.
truth.
This is good. Awesome.
This is a deep stuff.
I love it. It's a deep dive into mortgages. So good. So this is good. So we've talked about, the pre-approval. We've talked about, some of the penalties, the refinancing, the renewals. Let's talk about mistakes that people make and how to avoid them. If you're getting your first mortgage, what do you want to not do right now?
Probably the most common thing people do is change their financial situation somehow. And what I mean by that can be a lot of things. Change your job. You're on probation. I understand people want to change jobs, but talk to your lender first before you do that, because it might be better to wait till after it funds, especially if you're changing career fields and you're on probation. It's a mess. Or you buy a car. Or what some people will do is they get their house, they get all approved, and amazing, right?
Yeah.
They're going to go buy furniture now.
They go get a Leon's credit card and
Yep, they got
start
their
buying the
Leons and their brick,
furniture.
and they are buying their
Yeah.
furniture. It's all going to be delivered on the move-in day.
Yeah.
And the problem with that is that lender that lender can pull your credit at any time.
Right.
Doesn't have to ask you anymore. You've signed a document with them. They can pull your credit.
Yeah.
And some lenders do pull your credit the day before funding.
Ooh.
And if they find something there, a new expense, a new car loan, they can just pull that deal, and they will. And I know it sounds ruthless, but it is absolutely true. So you kind of have to, once you're pre-approved, and it's certainly once you have an accepted offer, you have to freeze
Just
your
lay
finances.
low.
Yeah, don't do anything. You
Yeah.
might be able to do something. I'm not saying you can't.
Yeah.
I'm saying talk. You have to
Right.
talk to the lender or broker before you do it.
Yeah.
Because maybe it's something like, maybe your ratios were already really low, so you're
Yeah.
just gonna get a, $5,000 on some furniture. It's not hardly gonna do anything.
Right.
Then run it through the broker or a lender can calculate it out.
Yeah.
You're good to go.
Yeah.
Go ahead.
And I would say also, like, don't be afraid to talk to your lender about those things. Like, make sure you're staying in communication. There's been many times where pre-approval, get the offer in place, it's accepted, all the conditions are removed, you're waiting for closing, and completely out of the blue, you lose your job.
Yeah.
Like, it happens. And so, but, communicating that, like, you might be afraid to say something. But like, I think also it's important because, it's going to possibly make or break the deal. Like, because like you said, you can be pulling that information anytime. So it happens. And I know from my own experiences that you guys can help navigate people through that. So
That's a really hard example.
Yeah.
I mean, when you lose your job, I literally just had this happen to me a month ago, where a client sort of wasn't giving me like the answers I was asking, or no, the lender was trying to call the client's employer and they weren't getting any of their phone calls returned.
Oh.
Lender ended up telling me, "Hey, just so you know, I've been trying to call the employer and I'm not getting any calls back. So would you mind asking the client to have their HR department give us a call back because we got to finish this part?" And then that's when he told me that he lost his job, that 30% of his team got laid off. And we still had time to do that deal. We did switch to a different lender to make it work.
Yeah.
But yeah, it's a
hard one.
It's the hardest one.
Yeah. And I think too, there's different options for people who are self-employed versus have a job that they get a consistent income for. So for those people that are self-employed, there's just a little bit of different stuff there that they have to consider.
Yeah.
And if people are moving in from other provinces, I ran into this situation when we moved here from Ontario. We've always had a mortgage. We've never had issues. We've never had credit issues. But when we moved here, we couldn't get a mortgage because we could not show 2 years of income in this province.
Well, I would say if you're in a self-employed role where you can work remotely,
Yeah.
then it probably wouldn't affect you. But if you're like, we own a car dealership in Manitoba and we're going to come here and
Yeah.
start over with a new car dealership, for example, that might be tough. It's
Yeah.
a totally different market and you have to restart getting clients and stuff.
Yeah, so there's lots of different things to consider for sure.
100%.
So other mistakes I'm thinking of are things like, we talked about it at the beginning, these online approvals. Don't do them. Don't rely on that as your information before you go out and start looking. I think in most cases, an agent that you connect with is one of the first questions they're going to ask you is, are you pre-approved? Or, have you talked to a mortgage person before we put you in the car and start showing you homes? We want to make sure that you can afford them. We don't want to waste your time or ours.
Absolutely.
So yeah, definitely staying away from those online ones, reaching out to a trusted mortgage person.
And you can tell just intuitively, like a client probably can tell the quality of their pre-approval. Just, if no one asks me for documents, you kind of know that you're not really pre-approved.
No.
Right?
Yeah. One of the things we haven't talked about too is the stress test. This is this could be a whole other podcast just on the stress test, but it is a real thing. Maybe just a real quick, if you can, explanation on what the stress test is.
Sure.
Because it is a major factor for people.
The stress test is basically when your interest rate's being calculated to qualify you. The stress test what we have to do as a broker, in addition to all the other things we analyze, is we have to increase your whatever rate you're actually going to get. We add 2% to it, and then we take the mortgage payment associated with that rate, and we use that and assume that's the mortgage payment that you're getting, that we're going to qualify you with that.
Okay.
But not your real mortgage payment, the higher mortgage payment.
Okay. So let's say the current interest rate is 4.25%.
Yeah,
You're looking at it at 6.25%.
exactly.
And you're not going to approve me unless I pass it at 6.25. Am I paying 6.25 or am I paying 4.25?
You're paying the 4.25.
Okay.
So it's not even something a client would even know is happening.
Yeah.
But we're doing it on every file.
Yeah.
We have to demonstrate to the lender the ability to pay at this higher rate. Of course, that's just there in case rates go up.
Right.
So
And that's on every mortgage? 20%, 5%?
it's on all purchases.
Okay.
On all refinances. The only time that right now you're not doing a stress test is if you're not, some lenders, and I mean very, very, very few, who aren't regulated by OSFI, Office of Superintendent of Financial Institutions, they may not require stress test because that's a Department of Finance rule, and not everybody falls under that
Right.
regulator. Okay, so the stress test does not apply though on switches. So when I say switch, I'm talking about going from one lender to another when you're at maturity.
I
Like
see.
how we talked about, you could just whatever lender you want at the end of the day. So those don't need to be stress tested because they were already stress tested.
Right.
And there's no new money, so there's no additional risk in the market.
Right.
So they could just go, and that could be important because you imagine you qualified at 1.9, now you're at 4
Yeah.
and then 2%. Like you might not even qualify to move your mortgage,
Right.
even though you're not adding any money to it.
Right.
Like you don't qualify
Right.
for your own mortgage, so you're stuck with that lender.
Yeah.
And you can't move. That's not really fair.
Yeah.
So they don't stress test you then.
Right. So with the renewals then, if you're adding additional money to pay off debt and whatever, is that additional money subject to the stress test as well?
Yeah, basically if you add anything to the mortgage, it's a new mortgage.
Yep.
It's a re-stress. So it's cut that out.
Yeah.
Re-stress tested again.
No, we're going to leave it in. 'Cause
Yeah,
It's
okay.
good.
Okay.
We got to have some bloopers.
Sure.
Okay. So it's re-stress tested.
Yeah.
Perfect. Okay. Okay. That's good to know. I mean, I think that's a really important piece too, because I think people kind of get mixed up on that. They think, well, now I'm paying a mortgage at 6.25. It's just, you had to pass that marker
Yeah.
in order to get the mortgage, but the rate is actually the lower.
Yeah, and I don't even, like when I talk to clients, I don't even mention the stress test. Like I just do it.
Yeah.
Here's how much you qualify for. That's all they really want. They
Yeah.
don't want me to tell them I'm using a payment of $30,800 a month
Yeah.
at 6.25%
Right.
in your file because
It gets very confusing. Yeah.
it's bonkers.
It is. It is. It is. It's very, very silly, but here we are.
Yeah.
Okay. Well, this has been great. So I'm going to do some quick fire questions for you. Just the first thing that you think of. I'm just going to ask you
Okay,
3 questions.
let's have it.
Do it. Okay.
Okay.
One thing every buyer should know about pre-approvals.
Okay. That they are not worth a whole lot.
Yeah.
So quickly, just pre-approvals. They're more. The most important thing to a pre-approval is that it's a rate hold, usually for 120 days. It's really important.
Okay.
Got a rate hold. Pre-approvals do provide that, but they don't provide you a guarantee of any approval because they probably haven't reviewed every single document.
Yeah.
And a pre-approval can really only do 2 things. You think of lending. I'm going on too long here, but when you think of lending, there's like 3 C's of credit: character, collateral, capacity.
Ooh.
Okay, and think like a bar stool. There's only 3 legs.
Right.
So you need all 3. If
Okay.
there's anyone missing, there's a problem. So character is your credit. How do you have a steady job, or are you getting a new job every week?
Yeah.
So character, and then capacity is how your ability to repay the loan. Okay, but there's one other thing that pre-approval letter can cover those 2 things, but it can't cover the last thing, which is collateral.
Right.
Collateral is the property. So sure, you buy a regular house or condo, that's great. But sometimes these properties are on leased land, or it's a co-living or co-housing property,
Right.
or it's
A leasehold
yeah,
or
or it's a
yeah.
trailer park,
Yeah.
a trailer hold
Yeah.
with,
Yeah.
and then those
Those are
are things that
different.
the stool might not be
Right.
as good on that one.
Right.
Like,
That's a great way to say it. I can
yeah,
actually see that. That's good. What's one overlooked cost that sneaks up on buyers?
property transfer tax.
Oh, that's a good one.
Yeah, all the time.
Yeah.
Because even if you're a second or if you're a second time home buyer, I think that's where most of the people that get caught in it. Because the first time they might not have had to pay a property transfer tax. Some home buyers do have to pay a property transfer tax because if they're buying something expensive. Okay, so but a lot of people don't think about it,
Yeah.
especially if they're from Alberta.
Yeah. That's a really good point. I want to circle back really quickly before I answer the last question. When we were talking about the rate hold, the 120 days, that means that they need to find the house and it needs to close within that time, correct?
Yeah,
Okay.
correct. To have that rate hold.
To have that rate. So if you go over that time, then it's subject to potentially a higher rate, which may not actually qualify you.
Correct.
So that's an important piece too. It's like if if you can't find it and you can't close within that rate hold time frame, you're going to have to potentially, if the rate goes up, maybe buy something cheaper in order to, to continue to qualify.
Right. Exactly.
Yeah.
So when rates are, yeah, you pretty much nailed it.
Yeah.
Want
Well,
to switch spots?
yeah. I've been doing this for a while. And, I'm speaking from my own experience too, because we had a rate hold and we were right to the wire and we literally had to, close on it on a certain date and we were still in our previous place. And then we had to talk about like a bit of bridge financing and all that kind of stuff while we, made that, it was a bit of a nightmare, but I just, from a realtor point of view, and that's part of our job is to make sure that our clients know, okay, this is your rate, this is how long it's for, and we've got to get this wrapped up before then.
Yep.
And we live in uncertain times. We don't know if the rates are going up or down or staying the same, so it's important that we keep an eye on that time frame.
100%. And it also brings back to like the important conversation is like, don't go to the budget. Like, don't go all the way because that is always where problems happen. They never happen people when they go under.
Right.
But when they go to their maximum, that's when all the things, all the springs start popping. The strata fee's higher than we thought, or
Right.
whoops, the rates just went up 1/4% in the last 4 months, and now you qualify. That you don't qualify for that anymore.
Right.
So all that is better to leave yourself a bit of breathing
More
room.
time. Yeah, that's good. Okay, if mortgage approval was a game show, what would it be called?
A game show, probably something like Penalty Jeopardy.
Penalty Jeopardy.
It would be like categories would be like, what the hell was I thinking, or interest rate differential hell. That's
Or GDS, TDS.
Yeah.
Yeah. I also was thinking the price is right. I mean, really, the price has to be right in order to get that financing in place. So,
that's true.
It's important. Yeah. So good. Okay. So I think we've covered a lot of really important information. We've kind of gone through the pre-approval process, the refinancing process, and sort of some of the pitfalls. Some of it sounds, a little bit negative, but it's the reality of it. It really is just such a wide range of things that have to be considered. And so reaching out to someone like yourself and, understanding what products are available, your time frames, that pre-approval process is just so important. So
Absolutely.
Yeah.
When you talk about like the negative or positive, like if you are working with a professional, that's just going to be hopefully a positive experience.
Yeah.
All of those things you don't need to worry about,
Yeah.
right? You've got somebody who's got your back. That's their job to do.
Yeah.
watch for all these things, tell you about it, warn you when you're getting into like from green to yellow to
Right.
red zone on some of your decisions. That's all we can do.
Yeah.
But
So
and
good.
then if with good advice, you have a positive experience.
Exactly.
I hope.
And then you have a home and you're excited and
That's
it's
right.
wonderful. So,
That's right.
Jason, thank you so much for your time today. I think it's been a great conversation. Certainly has enlightened me and reminded me of some things. And I think we made it fun. I don't think it was boring. It got a
Good.
little bit there with the percentages and but that's okay. It's part of the process.
Ratios. Yes. Yeah.
But thank you so much for joining us today. We
Thanks,
really
my pleasure.
appreciate it. Your information will be alongside our podcast so people can reach out to you and chat with you all things finance, which is great. And we want to thank you for joining us again today for another episode of the Red Chair Podcast. Be sure to click and subscribe so that you can get updates on new podcasts as they drop. We like to drop these weekly, and so we've got a range of topics for you, the consumer. You get to learn about who we are as agents and some of our key partners in the business, but also the perils, pitfalls, and the beautiful parts of the real estate process. And so we wish you well today. Thank you for joining us. Be sure to check in with us again at the Red Chair Podcast, and we will see you soon. Bye for now.